we were doing this 28th question. A company produces two products S and T which pass through two production processes X and Y, and the time which is taken by the products S and T in each of these process X and Y. So process X, in process X, product S takes 5 minutes and 7.5 minutes by T. Similarly for Y also. Then we have in a day, the company operates 15 hours and have an average downtime of 1.5 hours in X process. Process Y it is 1. So first we started working out with what are the productive hours in each of these processes. Then on that note we have stopped. So going further, we see that the question is asking us to talk about which process is a bottleneck process. So where is that there is some constraint, there is some kind of a limitation is what we have to identify. The question is about. Otherwise, generally, what is the bottleneck resource or what is the constraint is mentioned and then we work it out. But then here in this particular question, we have to identify which one is a bottleneck resource. So if 810 minutes time is available because it is everything is given in terms of minutes, we have converted the productive hours into minutes. So 810 minutes in process X and 840 minutes in process Y. If that is the case, how do we identify that? The point here is, apart from this, there is some other information which is given is sales demand. There is a demand. Demand for how many units? For S it is 50 units and Y it is 80 units. So this time, the available time of 810 minutes in process X, with that 162 units of product S can be produced. So yesterday we have worked out on the logic part of it. If it takes 5 minutes, so the point here is for in process X, if it takes 5 minutes for making each product, the time taken to make each product in each process. So process S, if it is taking 5 minutes, okay, and with the available 810 minutes, how many units of this product can be produced? That's the question. How many units can be produced is the question. So if we are looking into that, we got it as 162 for product S and 108 for product Y. Then similarly for process Y, we have to work out, take 840 minutes divided by 18 minutes. 840 minutes divided by 80. So that is 12 minutes. Is 70. How do we identify what is the bottleneck resource? This is what is the calculation we have taken up based on the available time. The available time is in total 810 minutes are available in process X. So if all these 810 minutes are applied in case of product S, total number of units which can be produced are 162. How did we get that? Is each unit, if it requires 5 minutes, with the availability of 810 minutes, we see that 810 by 5, 162 units can be produced. Okay, then product T, it says 108 because it is 840, 810 divided by 7.5. That is for process X. Then come to process Y, 840 divided by 18, 840 divided by 12. So that is what we have arrived at. What are the demands? The demand for each of these products is mentioned to us as, okay, the demand is 50 and 80. So when the demand is 50 and 80, process Y, see, the profit has to be maximized. The profit can be maximized by catering to the demand. The demand is demand from the customers is 50 units and 80 units. So when they sell all 50 units, all 80 units, then in that case, whatever is their desired objective, that can be fulfilled. But process Y, the availability or the available time is enabling them to make only 47 units and 70 units of S&T. They can maximize their profit, they can reach their objective when they can sell 50 units of S and 80 units of T, because that's the demand. So demand is not in their hands. So whatever is the demand, they should cater to the requirement to the maximum extent. So if if they have to produce 50 units, is process by enabling them to produce 50 units of S and 80 units of T? It is not enabling. There is a constraint there. There is a limitation. If they have to produce 50, the available time of 840 minutes is not allowing them to take up 50 units of product as production. The total production which can be taken up is only to the extent of 47. So 47 units is all what they can produce. So that is where they have a limitation. The demand is 50. So they should be able to take up 50 units of production. But the time is not sufficient. Time is not available. So there we have the constraint. The constraint is in process Y. So process Y constraint is not only in respect to product S, but that's the case even with product T also. So product T, the demand availability is 80. They they have a possibility to sell 80 units, but now they are with the available 840 minutes, they would be able to sell only they would be able to manufacture only 70 units. So which one is a constraint? Process Y is a bottleneck. 80 units of product T. So I hope you understood the concept. Is that clear?
Yes, ma'am.
Yes. 29th question, what is defined as an activity within the organization which has a lower capacity than preceding or subsequent activities, thereby limiting throughput? Throughput is the profit or the controllable profit, but then controllable profit is only after deducting the material cost, because that's the only cost which is assumed to be as the variable cost. So here, what is defined as an activity?
Bottleneck.
So for this one, there's no discussion needed also. We understand this one. For the 29th question, answer is A, bottleneck. Coming to 30th question. The following data relate to manufacturing company. At the beginning of August, there was no inventory. During August, 2,000 units of product X were produced, but only 1,750 units were sold. The financial data for product X for August were as follows. Materials is 40,000, labor, variable production overheads, fixed production overheads, variable selling cost, fixed selling cost, total cost for X for month of August is 109,800. And the question says the value of inventory of X at 31st August through using a throughput accounting approach is. Now, during August, 2,000 units of product X were produced. But how many were sold? 1,750 were sold. So what is unsold stock? Unsold stock is
8 minutes.
how much?
250 units.
250. Yeah. 250 units is unsold stock or the closing inventory. So we are asked to find out what is the value of inventory at 31st August. So 31st August is the end of the period. So that's nothing but the closing stock. So 31st August using a throughput accounting approach. Under throughput accounting, the only variable cost which is considered is the material cost. All the others, whether it is labor or variable manufacturing cost, fixed manufacturing, all of them are categorized or operating expenses, and that is at the next level. So that is, all of them are taken to be as fixed cost, operating expense or fixed cost, and taken at the next level. So when the cost is charged to the ending inventory, it would be only of the material cost, because that's the only cost of production which is taken or which is charged. So the logic would be um, production is equal to production, we have it as 2,000, sold units is 1,750. So ending inventory is equal to, we have it as 250. The only point what we understand here is material is the only production cost which is incurred. The rest of them are all taken as fixed costs. Fixed costs are not charged to the ending inventory under throughput costing. So logic, we can present it in a simple logic, that is, if they have spent $40,000 to produce 2,000, that's the number of units which are produced. The value of the ending inventory, which is 250 units, would be how much? So how much would be the cost for those 250 units? So that's the logic. under units and cost. So I'll put it here, the logic also. The production of 2000 units, they'll spend 40,000. Then for the this 250 units, how much would be the cost? So that's the logic there. Okay. Then we have question number 31. It says a manufacturing company recorded the following costs in October for product X. We have the cost given. During October, 4,000 units of product X were produced, but only 3,600 units were sold at the beginning of the October. Same is the logic. Then we have 32nd question. So we'll take all these things to the Excel sheet. Okay. So you only do the calculation and tell me what the answer is. 31. What's the answer?
I've got $2,000.
2,000. 20,000 the units are. Okay. 4,000. 2,000 only. Because for 4,000, if it is 20,000, 400, how much is it? So 2,000 is the answer. Seconds is a business manufactures a single product which sells for $45 per unit. The budgeted data for the latest period are as follows. We have production and sales given for 2,000 units, material cost is given, then labor cost, then production overhead, non-production overhead. Actual production volume and cost were as budgeted for the period, but the actual sales volume achieved was 1,800 units. There was no inventory at the beginning of the period. So here it is not just finding out what is the value of pending inventory, but the question is asking us to find out what is the profit for the period using throughput accounting. Profit is what we have to calculate. How do we calculate what is profit? So first we see the sales are made. Sales are made for though they produce 2,000 units, sales were only for 1,800 units. So what is unsold stock? Unsold stock is 200 units. But these cost material, labor, production, whatever it is. So these are the costs which are incurred during the period. Out of that, material cost is the only production cost which we are assuming, but that material cost is for all 2,000 units. We need to adjust that cost for 1,800. So only the 1800 cost has to be taken. We need to make that adjustment and then proceed further. The rest of them, which are production overheads and non-production labor costs, production overheads, non-production overheads, all of them are assumed to be as fixed costs. So those things also, if they are deducted, uh, then we find out what is the profit. So first we have sales. From sales, we need to deduct the material cost. Sales minus material cost is called as throughput. This is throughput. From the throughput, we need to deduct all the other costs, which are labor cost is there. Then we have the production overheads are there, and then non-production overheads also. So all of them, when they are deducted, the resultant figure is the profit for the period. So that is the logic what we have to approach. Okay, so let's start. The selling price per unit is
$45.
45, but the number of units which are sold is only for
1,800.
that's it. Okay. So check that how much is the sales value. Please multiply that.
81,000.
Now less material cost. So material cost proportionately we need to calculate. Material cost is total 13,500, but then we need to calculate only for 1,800 units. So 13,500 is for 2,000 units. So 1,800 units how much? Okay. So deduct this one. The resultant figure is called as throughput. From this, we have to deduct all the other costs. One is labor cost.
Ma'am,
Yes.
these costs don't have to be proportionate.
Which one?
The labor cost, production overhead, they don't have to be calculated
No,
proportionately.
they are assumed to be as fixed cost. We know that, no? So they are assumed to be as fixed cost. Um, Otherwise, technically, labor cost is a variable cost. It's a direct cost for that matter. It is a direct labor cost. But the assumption here in throughput is even if it is labor, even if it is, see, the production overhead also, there might be some variable component of it. But they are going with an assumption that they are all operating expenses and basically fixed in nature. For that reason, so you must be remembering the treatment of marginal costing. So what is marginal costing doing? It charges only the variable component to the ending inventory. The rest of all the costs are deducted in the current year. Only the absorption costing takes the variable plus the fixed manufacturing overhead and charges to the um, ending inventory. Okay, so that is what is done in case of absorption costing. But variable costing and throughput costing, they do not consider charging a portion of these costs to, even if it is fixed also, they are incurred only for the production purpose. So in spite of that, because of the nature that they are fixed in nature, nothing is charged to the ending inventory. So that is Okay, that is the way the accounting system assumes that. Fine. Therefore, though technically it's saying direct costs, all direct costs are variable in nature. But though it is mentioned, all labor costs are taken to be as fixed cost. Okay, so that reason we have to deduct it here. Question number 33. S Limited manufactures three products A, B, and C. The products use a series of different machines, but there is a common machine P, that is a bottleneck. The selling price and standard cost for each product for the coming year is as follows: A, B, C. Um, what is the return per hour for product B? How do we calculate return per hour? First, we need to find out what is throughput divided by
Time on the bottleneck resource.
product time on the bottleneck resources. So they've asked us only for product B, but anyway, we're doing so. Let's do it for all the uh, three products. First, find out what is throughput. After that, we can find out what is the um, a return per the bottleneck resources. The time is also mentioned. The last thing in the column, machine P minutes is given as 12, 10, and 7. So 12, 10, and 7. Just divide by that and then find out. So the question is asking us to find out in hours, but let's first find out return per minute. Return per Okay, so the return per hour would be just take calculate return per minute and then multiply into 60. So there are 60 minutes in an hour. So how much would be the return per hour? It just multiply it into 60. So we would get what is return per hour. I think with that we come to the end of the problems based on throughput accounting. So that is what is my understanding.
Ma'am,
Yeah,
could you show the 31st sum once, ma'am? I didn't write it on the values.
sure, sure. 31. I mean, the you gave the answer, so I just wrote the answer. The logic would be the same way how we have done. That is, if it is for the number of units, if we are taking and the amount, number of units are the production has was for 4,000 units and the material cost was 40,000. And the ending inventory happens to be as 400, that is 4,000 minus 3,600 is 400. So this is how much, that's the logic. So calculation would be value of ending inventory will be uh, take it up as 400 into 40,000. Sorry, it is 20,000, no, I'm really sorry about it. This is 20,000, so divided by 400. This is also 20,000.
Yeah, ma'am, I got it. Thank you, ma'am.
Yeah. So when we go to the file, that's the last question on throughput. But the next topic starts from question number 34. So we are going back to the PPT. So let's go back to the PPT and then just a second. Um, Apart from this, we also have other topics like joint product costing. Then we have apportionment of the joint cost between the joint products. So there are methods. Um, I do not know where is the sequence of these questions, because immediately after that some other topic has started. So I am not sure where the problems are included in the examination kit. So as of now, I'm putting it on hold. Um, I would not be teaching you, but then once we come across, I didn't find the questions in that. So once we come to that, then we will. I think they are there at the end. For the moment, let's do the next topic. So there are, I'll give you a gist of it and then we'll proceed further. The next topic what we have here is joint product costing. But maybe the next class I will take it out from the examination kit and we'll take up the questions. We are dealing with the cost which are not identified with the production. So that is the topic what we are discussing. See, those costs are also called as overhead costs. In the case of overhead costs, what was the traditional costing method's assumption? The traditional costing method was assuming that there should be a predetermined overhead rate, either based on labor hours or machine hours or output. But then there are modern accounting techniques like ABC, which suggests that instead of going with the traditional method, to apportion the the actual amount of overhead cost, identify what are the activities and depend on the activities and take it forward. That is what is the suggestion given by ABC. So we also have looked into how do we apportion the overhead cost. Now, the logic of dividing and distributing also further extends to, we see another accounting system which is called a joint costing system. Now, when the production process is taken up, we see that for some of the products, let's say that there are for example, let's assume that there are three products which are produced by a business. Let's say that all the three products in the initial stage requires the same production process. So all the products go through the same process, and the cost also would not be separated, but it would be incurred as a joint cost. Okay, all the costs are collected and then they are taken and apportioned. So the cost which is incurred is called as the joint cost, but this would be incurred only until a point where they get separated. So because these are three different products, so it is only in the initial stages that the process is the same and the cost incurred is also the same. So there comes a point where we also call this one as split off point. It's a point where these products are separated. Okay, so let's name them as product A, product B, and product C. So now they get separated because it is not the same process, maybe some variations, and then the product itself is a different one. But after finishing the initial process, they get separated, and we see that from the point of split off, after that, anything which is needed is different for each of these products. So individually, the costs are incurred separately. So they are also called as separable costs. First, initial costs which are incurred till the split off point, we call that as joint cost, because the process is same for all the three products. So when the process is same, when they pass through the same process, the same activity, the same cost. So at that time, there is no separation of the cost. There is nothing which is clearly identified, but as a common cost, as a common joint cost, the costs are incurred. Fine. Then at some point they get split out. And when they get separated, when they are split out into different products from the split off point, and further, the any other cost which is needed will be accounted separately as after separation cost or separable cost. Okay. Now the point is, see, one of the objectives of cost accounting is to know what is the cost incurred. That is determining the cost price per unit, so that helps in determining the selling price per unit. So every product has to know what is the total cost incurred for the production process. But a portion of the cost, which is also called as common joint cost, is not accounted separately. It was accounted as a joint cost, as a joint common cost. It was accounted. So when the cost is accounted as joint cost, now we need to think about how do we allocate them? How do we divide and distribute it among the products which are produced? So after separation, anyway the costs are known because separately they are incurred. To these after separation costs, we have to bring that portion of joint cost and add it to find out what is the total cost. Once we know what is the total cost of the product, add a profit margin to decide what is the selling price. So concept is this, that is about the joint product costing. So it says that it is used when more than one product is produced in the same process at the same time. Then byproduct. So here there are terms like joint products and byproducts. So see, if the production is taken up to produce products which have more or less equal importance, and the intention is also to produce those products, we call such products as joint products. But because of the production process, if there is any other product which is produced as a result of the production process, it is not intentionally produced, but it is a product which is produced because of the process which through which the material goes. I mean, it's taken forward. So in that case, any product which is produced and also has a very less value as compared to the joint products, we call that as a byproduct. That is not intentionally produced, but because of the production process, if there is any output which is generated, that is called as a byproduct. So we need to know that the difference between joint product and byproduct. So byproduct, small revenue can be, so there is some revenue which is generated by selling this byproduct. The treatment of the revenue from the byproduct, we need to remember some point there. When we work out the questions, I will help you out. The way the scrap is treated in case of a factory, when scrap is any wasted material, when it is sold, some amount is realized, so that is generally deducted from the factory overheads. That's the same treatment what we have to adopt here in case of joint costing also, with the sale value of the byproduct. So first understand that the byproduct is a product which is produced because of the production process, but not intended to produce that one. It was not intentional that this should be produced, but because of the production process, if anything which has come out. Now that when it is sold, there is a point what we have to remember in terms of how do we adjust that one. Then cost of each joint product is a share of the common processing cost up to the split off point. And then it says how do we apportion? Now, these costs, until this split off point, the costs are incurred as common costs, joint costs, combined costs. So they have to be divided and distributed. Unless and until they are divided and distributed, then we would not know what is the cost incurred for each product. So the topic what we have here, what is the apportionment of common costs between joint products? What are the various methods which are available? The methods which are available here, we have first we need to know the technical estimate of common processing resources consumed by each joint product. Then what is the number of units of each product? There are many methods, but whatever is covered in our syllabus, we will stick to that only. So uh, market value of each joint product at the split off point, then net realizable value, that is final market value less cost incurred up after the split off point. So whatever is covered in our syllabus in terms of what are the various methods of apportionment of joint cost is what we will look into. Okay. So what are the various methods of apportionment of common cost between joint products is what we will look into that. In the sequence in the examination kit, it is not given, but because we have done the topic, I will take it out from the material. And I think question number 171 onwards, the questions are there. That is also not given in. Okay. Whatever we come across, one or two questions we'll do today, and then later on in the sequence when we are going, we will, if anything comes up, we will take it up at that point of time. Under short-term commercial decision making, we need to understand what are the relevant costs. At that time, we have to once again take it up. I'm just working out here question number 171. I'll put this one in the Excel sheet, and then one or two questions will do. But the rest of them, when we are going in the sequence, at that time we'll take it up. Okay, let's see question number 171. A company manufactures two joint products and a byproduct in a single process, which are all sold as soon as they are output from the process without further processing. Joint costs are shared on the basis of the sales value at the split-off point, and the revenue from the byproduct is credited to the cost of production. The budget for the next period is as follows. We have processing costs 45,000. Then the output in units is given. Like for X it is 250, Y 400, and Z is 3,000 units. Selling price per unit. So at the split off point only they are sold. There is no further processing which is taken up. So the value which is realized at the split off point is taken as the basis for the apportionment of the joint cost. How much is the joint cost? We see joint cost is given as joint cost is given as 45,000. This 45,000 has to be apportioned among X, Y, and Z. So when we have to apportion that, what is the basis? There are many methods like the output is taken as the base, or the quantities which are used in the production, that is the um, weight is taken, volume is taken, the sale value at the split off point is taken, the sale value after further processing is taken. These are all methods what we have. Then we have gross profit method. So whatever is the method which is discussed in your syllabus, we will restrict it only up till that. Here it is a very basic question which says the sale value at the split of point, because no product is taken up for further processing, so they are sold at the split of point. So let's just find out what is the cost allocated. There are two main products, one is X and one is Y, and the last one Z is a byproduct. Okay, how many units are produced? Units produced are 250, 400, then 3,000. The selling price is given. So joint cost is 45,000. So 45,000 will be apportioned in this ratio. That is 20,000 is to 40,000 is to 600 in this ratio. So when we add them up, they come out to be as 60,600. So apportionment of joint cost. Joint cost is equal to 45,000 into what is the share of X? X sale price is 20,000 divided by the total sale value of all the three products is taken to be as 60,600. So this is the allocated or apportioned joint cost for each of these products. The question is asking us to find out what is the cost per unit of the of product Y. So cost per unit would be, this is the cost which is allocated divided by the number of units 250. Just a minute. Just a minute. Just a minute. I am extremely sorry. I made a mistake. Apportionment of joint cost. I'm really sorry about it. So the joint costs are, I should have written. This is byproduct. Byproduct. I've been telling you also there is an adjustment. We need to, I will tell you at the time. I'm really sorry about it. So these are not the figures. Joint cost is 45,000 less sale value of byproduct Z, which we got it as 600. So joint cost to be apportioned. While explaining, I explained, but I don't know. I made a mistake. So here it would be 45,000 minus 600. So after this, the remaining 44,400 has to be apportioned. Apportioned in the ratio of 2 is to 4. So that is the logic. The sale value of X and Y is 20,000 and 40,000. So 2 is to 4. In the ratio of 2 is to 4, it has to be apportioned. So take is equal to 44,400 into 2 divided by 6. Then we have is equal to 44,400 into 4 divided by 6. Okay, once again, I am extremely sorry about that. So there are two main products and one byproduct. We have the units which are mentioned 250, 400 and 3,000. The sale values are also given as 80, 100 and 0.20. First, we need to find out what's the sale value of all the three products. So the revenue which is realized by byproduct, by the sale of byproduct, should be used for adjusting the joint cost. So they totally incurred the joint cost which is incurred is 45,000, but out of 45,000 now they have realized 600 by selling the scrap. That was never the intention to produce, but it was generated because of the production process. So that 600 has to be deducted from the total joint cost. So the remaining amount of joint cost which has to be apportioned is only 44,400. Now the sale value of X and Y is in the ratio of 2 is to 4. So in the ratio of 2 is to 4, when we divide and distribute, that is 44,400. See the formula bar, 44,400 into 2 divided by 6. And here it is 44,400 into 4 divided by 6. Then we get what is the joint cost of a portion to product X and product Y. Slightly was not alert. Sorry. Then we see question number 177. This is also about the joint cost. The standard output from a joint process was 5,000 liters of product K, 3,000 liters of product L, and 2,000 liters of product M. The cost of the joint process was 156,000. The company is now deciding if it should modify product X by putting it through an additional process. In order to help with that decision, the best way to apportion the joint cost of 156,000 to the product is the standard output is given. Um, Joint process was 5,000 liters, 3,000 liters, and 2,000 liters. The total cost of joint process was 156,000. The company is now deciding if it should modify product K by putting it through an additional process. In order to help with that decision, the best way to apportion the joint cost of 156,000 to the product is, so see, if it was only based on what is the method which is adopted to apportion the joint cost. This kind of looks like a logical question. See, if it was the physical weight method, the physical weight method talks about the outputs are 5,000 units, 5,000 liters, 3,000 liters, and 2,000 liters. That is what is produced, the standard output. Fine. Then, if it was only that thing, we can take the ratio as 5 is to 3 is to 2 and apportion this cost of 156,000. That is a simple, straightforward thing. But the next line talks about the company is now deciding if it should modify product K by putting it through an additional process. The decision is connected to this thing. Which method will tell that it should be taken up for further process? There is no connection. So that is a decision which is not anyway connected to the method of apportionment of joint cost. If the question is directly asking us, in order to help with that decision, it is saying that it is not a straightforward question. To arrive at a decision, what is the way in which how are they connected? They are not connected at all. Okay. That is a decision which has to be taken up later on. Okay. First, we have to only focus on the method in which the joint costs have to be apportioned. So from the given set of information, we can take it up as a physical measure, or we can take it out the sale value at the split of fund, which we've done it in the previous question. Or sometimes when there is all three of them are further processed, then we also consider what is the other further processing thing, and then um, in a way we arrive again, we come back to the split of fund and decide on that. So there are methods in which, but connecting the decision to the method is not a situation. See, whether you want to process it or not is depending on what are the situations prevalent for that particular product. The decision is not subject to the method of apportionment of joint cost. So we should go with the answer. Answer is D for question number 177. So answer is D. None of the above. Why? Decision to further process. I do not know what other questions are there, but for the moment, because we just have learned the concept, any one or two questions which we have come across, we will end it here. But anyway, we will go in the sequence question by question. So if we come across any other joint product allocation problems, at that time we'll take it up.
Ma'am?
Yeah.
Ma'am, actually, I have a doubt, ma'am.
Yes.
In the method of during the method of apportionment, we need to calculate the value of the further process in the joint cost, ma'am.
We don't have to calculate. That would be given, no? So whatever is the cost of further processing will be given. There is a method which says that there are costs which are further processed until the split off point. The costs which are incurred are joint costs. After split off, they are separable costs. So if all these things are given to us, after separation cost is also given, joint cost is also given, then the sale value is given. So in that case, one method talks about take the sale value. From the sale value, because separable costs are already known to us, that would be given. So when we deduct that, the separable cost, then we come to the value, net realizable value at the split off point. Net realizable value at the split off point. So that can be taken as one method of apportionment of cost. Then we have a gross profit method. Then we have only the sale value at the split off method. That's what I'm saying. So separation cost is not what we are to calculate. That is not, that is a given fact. What is the cost which they have incurred is a given fact. It is not about how do we arrive at that figure. That is not the case at all. Is that your question? How do we calculate separable cost?
Actually, why can't we? My question was that, ma'am, do we need to consider while calculating the joint cost?
Ha. So when we are apportioning the joint cost, depending on method. So one method is when the separable costs are given, we go in a reverse direction to come to the value at the split off point and take it up further. So um, the methods are the physical weight of the input could be a method, physical weight of the output could be a method, sale value at the split off point is a method, sale value after the after further processing is a method, gross profit method is a method. So these are all methods. So if that is the case, we come down to the point where they are split out because they have already been processed further. So take the sale value, deduct the separable cost, work it out backwards, and then arrive at the net realizable value at the split off point. That is not the actual sale value at the split off point, but that is a realizable value at the split off point. Then that will be taken as the basis of apportionment.
In that case, can't we take the ratio, no, ma'am? 5:3:2.
We can see it is the question again. Once again, you please look into this one in order to help with the decision. But decision is unconnected, no? What is the proportion in which the joint cost should be apportioned? If the question addresses like that, then A will be the right answer. Because with the given set of information, all what we have is the weight of the output 5,000, 3,000, 2,000. If the question was not framed um, to understand how the joint cost should be apportioned. The question is connecting some decision whether or not they should be processing it further, connecting it to the apportionment of joint costs. They are not connected. That point we have to understand.
Okay, now I understand.
Yeah, the question framing itself. Otherwise, see, with the set of information what we have, if the question was how would we apportion the joint cost, A bit would be the right answer in the ratio of 5:3. Okay, so if at all, if we come across any other joint product cost, this is very, very minimum what we have worked out. Only 2 questions we have done, but I do not know where are they in the material. So as we move forward, working out question by question. So if we come across, we will spend time on that. But otherwise, for the moment, we are going back to the PPT to see what is the next topic. So the next technique what we have here is what is digital costing. So digital costing, what is the meaning of that? A digital product typically refers to a product that is stored, delivered, and consumed in a electronic format. So accounting for that in an electronic mode, in through electronic medium. So anything which is accounted for there in an electronic format, we can call that as digital costing. A digital product typically refers to a product that is stored, delivered, and consumed in an electronic format. So what is the comparison with the physical products? The point of difference between a physical product and a digital product. We see marginal cost, key elements of the total cost. There are no marginal costs here. What is a marginal cost? Marginal cost is a variable cost. See, the accounting is done there in the electronic format. So, technically speaking, they are zero. Then standard costing, key to determining total cost, few applicable standards. Then what are the overheads? Absorbed based on activity drivers. Drivers are difficult to determine. What are drivers? Drivers are about the basis of apportionment. Drivers are basis of apportionment. Fine. Then overheads are absorbed based on activity drivers. Drivers are difficult to determine. Pricing, cost drives prices. Target price might drive target cost. Timing of cost is upfront and predictable. Spread over product life and harder to estimate. So what is this concept basically talking about? One second. Okay, some disturbance. When we are talking about the comparison, what is the marginal cost? What is the standard costing? What is the overheads? What are the pricing issues and the timing of costs? So, what did we understand as digital products? Those products which are stored, delivered, and consumed in an electronic format. Can you think about any such product which can be um, dealt only through the electronic format? Any example which you can think about? So when we are talking about only through electronic format and there is not physical storing of the product, so it is technically it is not a tangible product. So anything which can happen only through the electronic format. Any example? All the products which are bought through the electronic mode, like you could buy the soft copy of various sometimes some information is bought, some books are bought, some articles are bought, games are bought. There is no physical product, there's no tangible product as such. It is basically intangible, that exists
Bitcoin,
only. Yeah.
like Bitcoin.
um Take a basic example here. Let's not get into that technicality about the Bitcoin. We can take a simple example because there are so many other intricacies about the Bitcoin. But here, for a digital products, what are digital products? Let's go with the. I mean, that has too much of intricacies which are included in that. For the moment, let's understand in a simple concept about what is a digital product. Anything.
Like ebook, ma'am.
E-books, that's right, that's right, that's what I'm saying. Books or articles or information or games on I mean day to day what we use. So they're simple. I mean you can only access it when it is there in the laptop or phone, or I mean you would be able to. There is no such physical format of that which you can keep it in a particular place, store it in a particular place. So that is the point there. Okay. So what are the key elements of total cost? So once it is created, that's the cost, that's it. Every additional unit which is made, there is no additional cost. It is just you need to copy that and keep given access to someone else. That's it. So the marginal cost is virtually zero. No additional cost which would be incurred. But in case of a physical product, to produce one more unit of the product, variable cost is needed, a marginal cost is incurred. But here in case of digital products, there is no marginal cost. Virtually, it is zero. Once the product is made available, that's it. It can be used n number of times, of course. But the access may be limited by the seller. It is not available to all of them. Okay, sometimes videos which are to be watched also only when you pay the rental charges or download charges, then you would be able to. But that is only restricted to a particular system. It cannot be viewed in any system. Okay, so it goes like that. See, the access of um, the television thing which we are watching also, so subject to, see whether you are a viewer of that particular. Amazon is there, Netflix is there. These are all digital products. You can only watch through an electronic mode. Otherwise, you cannot download and store it anywhere. That's the point there. So there's no physical product. So the marginal cost is virtually zero. In terms of standard costing, um, standard costing key to determining the total cost. What is standard what is standard costing is how much should the cost be uh, incurred, what are the standards which are to be followed, when is it considered as favorable, that all those things are taken into consideration. So there's a limit which is decided, there's a standard amount which is decided, and it is not possible to exceed beyond that. So that's standard costing part of it. Then in case of digital products, we are not very particular. The next topic what we are going to do is about standard costing only. So we're going to see that item by item, all the elements of cost, how the standards are decided. So it would not go on par with that, because the manufacturing cost of the digital product is not on par with the physical product, but there would be some few applicable standards are there. Then the pricing will be cost. What is the cost will decide on what is the price. Cost plus profit is the price in case of physical product. Now here it would be target price must drive target cost. There is a concept called as target costing. That is, they decide on what is the price prevailing in the market, take the same selling price, they decide on what is the target cost. So the concept is also there as a part of your syllabus. So when we come across, we will see that it is not the regular procedure of deciding the selling price, which is selling price is equal to cost price plus profit. But the logic there would be about taking whatever is the price offered by the competitors in the market, take the same price. Then they deduct what is their desired profit margin from the total amount of selling price. So once the price is profit is deducted from the price, the resultant figure is target cost, and they work out on reaching that target cost. So that could be a situation in terms of pricing. They may not be deciding on the pricing, but whatever is the price of the competitor, that will be taken as the price. So that could be a situation here, because there is no concept of incurring additional cost, the incremental cost, the marginal cost, that is not there. So the pricing part of it is not subject to what is the cost which they are incurring, but it is taken as the price prevailing in the market. What are the timings of the cost? Are upfront and predictable. Now spread over product life and harder to estimate. How long will the how long does this product survive is not known. So estimating the total cost and then deciding the selling price is a difficult task in case of digital costing. So that is what we have under digital costing. So this would be the last topic under costing techniques. There are certain advantages and disadvantages, benefits which are associated with digital costing system. We will look into that now. After that, the next topic what we have is variances. So maybe today we will discuss about this and then take up the questions which are there in the exam kit, and then tomorrow's class we can start with variance analysis. So what are the digital costing systems? A digital costing system is dynamic and involves linking internal digital systems. Example, purchasing systems with those of suppliers, customers, and the external market. Data is gathered from all these different sources in real time to give up-to-date costing information. What are the features and benefits? It's real-time, up-to-date information because everything is available on the electronic format. Then access to a wider variety of resources, reduced operational costs. Why reduced operational costs? There's no marginal costing which is incurred. Allows better understanding of costs, more accurate costing pricing. More accurate costing, there are no other overheads which are incurred. There are no wastages, there's no scrap, inefficiencies are not there. So it talks about more accurate costing and pricing. Then improved communication, faster decision making, and then they have a better cost control possibility. So when we look into the exam kit, The last question was 33, no? We have done.
Yes, ma'am.
So from 34 onwards, there are few questions on digital costing. Let's take up these questions because these are theoretical questions. We can do it here only, not in Excel sheet. The first question is question number 34th question. Did I put it on the screen? Which of the following statements regarding digital product is not true? So whenever we have these questions in a negative sense, so when they are addressing in a negative sense, um, keep a note of that not, does not, is not, not an advantage or something like that. If they are addressing, that would be given in a bold font, so it should not miss your attention is the intention there. So um, that is what we see here. It is not true, that is put in a capital because the questions, the entire question is in a bold format. The question part, addressing the question part is always in a bold format. You uh, bold font. Not is a word what we have to focus, so that will be in capital, caps lock. Okay. um, the high marginal cost of digital products makes them difficult to price. The lifespan of digital products can vary greatly. They are often recurring cost for digital products. Determining cost drivers for digital products can be very difficult. It is not true is, what do you think is the correct one?
A.
A is the one because virtually the marginal costing is zero in case of digital products. So that's an advantage. So, but here the high marginal cost of digital products makes them difficult to price. That's not true. 35. A company with audio expertise has had great success in selling physical testing equipment to amateurs who want to personalize their home listening experience. So, this is about the music. It is now considering providing the testing software through a downloadable mobile application. Consider whether the following are likely to be higher or lower for the mobile phone application than for the existing physical equipment. Higher and lower. So, which of them is correct is what? The lifespan of the product is higher or lower. The total labor cost, inventory cost, infrastructure cost. First one, is it higher or lower? This is an audio expertise has had success in selling physical testing equipment to amateurs who want to personalize their home listening experience. So now they are considering providing testing software through a downloadable mobile application.
Ma'am, I think higher, ma'am.
Higher. So this would be higher. The total labor cost, is it higher or lower?
Ma'am, is it lower?
The points also talk about the advantages. So it says that reduced operational costs, so improved cost control. These are all advantages. So on that note, it should go. So the total labor cost should be lower. What about inventory costs? There's no physically, there is no storage cost because there's no physical place which is needed to be stored. So inventory cost also would be low. Infrastructure cost would be high because this is depending on the digitization, electronic, the technology and all. Into that, there should be investment made. So infrastructure, the facilities, those things, the cost would be definitely higher. 36th question, which of the following is unlikely to be used when costing digital products? Marginal costing, absorption costing, activity based costing, and target costing. So
Option D, ma'am.
unlikely, not likely, unlikely.
Ma'am, A, ma'am, marginal costing.
Because virtually there is no marginal cost incurred. So unlikely is marginal costing. Which of the following is not a typical feature of digital costing? Prices are obtained electronically from markets. Systems are integrated with customer systems. Intelligence capabilities are built in. The product cost may constantly change. This one is also not a typical feature of digital costing. The digital costing system is dynamic and involves linking internal digital systems with those of suppliers, customers, and external market.
Ma'am, D.
But it says not a typical feature of digital costing. Prices
Digital
are
costing, it allows for better cost control, ma'am. So if cost control is good, that means that it should not constantly change. That was my logic. I don't know if it's right.
prices are obtained electronically from markets is a feature of digital costing. So,
No, ma'am, B. The product cost may constantly change. Then.
huh, B. Okay, I'm sorry, I heard it as A. That's why I paused for a minute. Consider whether the following statements about digital costing are true or false. There is a focus on smaller number of suppliers, fewer overhead drivers are used, large volumes of data are processed. The digital cost can be created very quickly. Large volumes of data are processed. Yes, the customer base would be large. because everything is through electronic mode. So definitely the customer base would be large. The digital cost can be created very quickly. That also can be taken. See the additional see once it is manufactured, once it is created, that can be copied for any number of units, so that is no issue there. And once it is created, once the cost is determined, after that for the additional production there are no costs which are needed. So on that note we can take it as once it is understood or ascertained, that can be taken because there is no more marginal cost which is incurred. So on that note we can take this as true. There is a focus on small number of suppliers. So is that talking about anything about suppliers, small number of suppliers? So with those of suppliers, customers, and the external market. So on that note, we could put this one as false. Fewer overhead drivers are used? No. Um, okay. So that will be the last question here, 38. And the next topic is variance analysis. It is a lengthy topic. Maybe we would spend some amount of time. So
Ma'am,
yeah,
actually, I have a doubt in the 37th question.
37. Yeah.
Yes, ma'am. How it is not integrated with customer systems, ma'am?
Not a typical feature. See, prices are obtained electronic. See, it is not that it is not at all, but not a typical feature. So when we, on a relative note, when we compare that, the prices are obtained electronically from markets is the feature. Intelligent capabilities are built in is also a feature. The product cost may constantly change because more number of units which are produced divided by the total number of units. Cost curve is a decreasing curve. So there's say as the output, if the cost is here, as the output cost per unit keeps falling down as the number of units produced. Therefore it is constantly varying. So it is not that there is a cost which is proportionally increasing along with the increase in cost. That is not there at all. So once for all, once the cost is incurred, the cost keeps decreasing because there is no more variable cost. The cost initially whatever is incurred is the cost. With every additional unit which is produced, cost falls down. Systems are integrated with the customer systems, so they are integrated for some benefit, but the intention is not to be integrated with that. Even if without being integrated with that also they can still the costing part of it is accounting for the cost of those digital products. That is about it. How they take it up is the next. How they deliver the product is when they are connected, but that's not a part of the costing part of it. The costs are about what is the target cost. Target cost is achieved by taking the selling price from the market, deduct the desired profit margin, and arrive at the cost. So it is uh, dealing with the target cost. That's the first point. Second point, the cost of building this intelligent capabilities is the research and development, innovation. All those costs is a part of the cost. Third one also is a part of the cost because the cost per unit reduces or decreases with every additional unit which is produced and which is delivered to the customer. So um, Since costs are not proportionally increasing, it would decrease. So the product cost may constantly change.
Okay, ma'am.
Then delivery part of it is, yeah, that's what B is the right answer. So that would be about the costing techniques. So what we have learned. Then we have variances. So that's a very long topic with many variances to be calculated. So the focus will be about what are the elements of cost. We see the material, labor, and expenses. Expenses are the direct expenses, but there is nothing which is anticipated for that, which is decided as a standard. But the third element which is taken under standard costing is about the overhead cost. So standards are decided as to how much cost should be incurred. That is about the cost variances. So under cost variance, we again split them into the material variances, labor variances, and overhead variances. That is about the cost variance. The revenue variances are also calculated. The revenue variances are in terms of what is the sales variance. Sales is how many units should be sold, at what price should they be sold. That is a decision which is made, or that is a planning which is taken up. But in reality, whatever is planned may not happen, because what is planned is for the future. When that period of time comes, that becomes a reality. At that time, implementing whatever is planned may not be a possibility, because there's so many other factors also which affect. So from time to time, the actual performance has to be compared with the already planned performance, or the plans, or the standards which are decided. So these standards are decided for the income, the revenue part of it, and the second standards are decided for the cost. So when the actuals are implemented, the actual performance is compared with the planned performance of the standards. If they both are same, no issue. Okay, things will be carried on smoothly. But if there are variances, what are the reasons why there are variances is what is looked into. Okay, then measures are taken to control the deviations, or to ensure that they go according to whatever is planned, because they have decided with a focus on achieving the organization objectives. So that is the purpose here. So for that, for the cost variances, we have the cost variances as the material, the labor, and the overheads. Overheads are again split into variable and fixed. Under each category, again, we have a list of variances. So the cost variance, the price variance, the quantity variance. Whatever is covered in your syllabus, going by that, we will take it up this particular chapter. So variance analysis is the next chapter, what we will be looking into. So tomorrow we'll start. It's time now. So tomorrow we'll start and then take it forward. Please put a message to your friends. Ask them to come join.